America's national debt has reached nearly $38 trillion as of December 2025. This isn't a future estimate or a projection. It's the real number sitting on government books today. Many people think it doesn't affect them, but that belief is dangerous. While most were busy scrolling social media or watching Netflix, the world's largest financial institutions quietly began shifting massive amounts of money out of dollar-based assets. This isn't a conspiracy. It's visible in public filings, treasury data, and verified capital flow reports. Global debt has now crossed $251 trillion, almost 235% of global GDP, the highest level in peacetime history. In the US alone, debt jumped more than $2 trillion in less than a year. What makes this situation alarming is that history shows the same pattern repeating itself. Every major reserve currency empire has followed a four-stage cycle: rise, overexpansion, silent capital exit, and collapse. First comes growth, when a nation becomes the center of global finance. Then comes excess, as governments spend beyond their limits. Next is the quiet escape, where smart money moves out before the public notices. Finally, the system breaks. Currencies weaken, markets crash, banks fail, and the middle class suffers. The signs are always visible. The real question is whether people recognize them before it's too late. Spanish galleons once returned from the Americas carrying more gold and silver than Europe had ever seen. The Spanish real became the world's reserve currency. International trade required it, and Madrid turned into the financial heart of the known world. Spain's power looked unstoppable. King Philip II controlled much of Europe. The Armada ruled the seas, and wealth poured in from colonies across 3 continents. But success led to reckless spending. Spain financed endless wars against France, England, the Ottomans, and the Dutch. It maintained massive armies, costly palaces, a bloated bureaucracy, and expensive religious campaigns. By the mid-1500s, government spending reached nearly 3 times its tax revenue. The gap was filled with borrowed money from Italian bankers and German merchants. As long as gold kept arriving, nobody panicked. Asset prices rose, and confidence stayed high. Quietly, the smart money began leaving. Major banking families shifted assets to Genoa. Creditors demanded repayment in gold, not promises. Merchants moved operations to Amsterdam after reading Spain's balance sheets and seeing extreme interest rates that signaled distress. In 1557, Spain defaulted. Then it defaulted again and again. Within decades, inflation crushed the middle class and Spanish dominance faded. Wealth migrated north, and Amsterdam became the next global financial center. Asset prices in Amsterdam became disconnected from real economic value. On paper, everyone looked rich. Even the Bank of Amsterdam, considered the safest institution in Europe, was secretly lending depositor money to finance government wars. Long before the term existed, it was practicing fractional reserve banking, stability on the surface, danger underneath. Stage 2 was clear. By the 1690s, smart capital began to move. Major banking families shifted operations to London. Sephardic Jewish merchants who built Amsterdam's wealth started relocating. Portuguese traders opened offices in England, and German financiers slowly withdrew funds. They understood what the public did not. The Bank of Amsterdam had effectively been insolvent since the 1670s, using new deposits to pay old withdrawals. Confidence kept the system alive. Stage 3 was underway. In 1795, French revolutionary armies invaded. The Dutch Republic collapsed, the guilder lost value, and the bank's hidden problems were exposed. Depositors were wiped out, riots followed, and the Dutch Golden Age ended almost overnight. After nearly 150 years of dominance, power shifted to London. Britain became the next financial empire. At its peak, it controlled nearly a quarter of the world. The pound sterling ruled global trade for over 2 centuries, and London financed railroads, mines, and infrastructure worldwide. But 2 world wars changed everything. Debt exploded, the gold standard failed, and money printing increased. After 1949, quiet capital flight began. Corporations redirected investment to America. Wealthy families moved assets abroad. Talent followed opportunity. By the 1960s, investment collapsed. In 1967, the pound was devalued. And by 1976, Britain needed an IMF bailout. The empire survived politically, but financially, its era was finished. When the pound lost its reserve currency role, global trade shifted to the US dollar, and Britain's long financial dominance ended permanently. Stage 4 was complete. Across 5 centuries, 3 empires and 3 reserve currencies followed the same 4-stage cycle with the same result. Spain, the Dutch Republic, and Britain all moved from power to collapse in an almost identical way. Now consider the United States. In 1944, the Bretton Woods system made the dollar the world's reserve currency, backed by gold at $35 an ounce. After World War II, capital rushed into America. U.S. markets became the deepest in the world, and investors everywhere wanted American stocks, bonds, and real estate. From 1945 to 1971, the U.S. enjoyed unmatched dominance. Stage 1. In 1971, President Nixon ended gold convertibility, turning the dollar into pure fiat money. With limits removed, spending surged. U.S. debt rose from under $1 trillion in 1980 to over $38 trillion by 2025, a massive expansion in just decades. But government debt is only part of it. Corporate, household, student, and credit debt pushed total U.S. obligations above $100 trillion, nearly 4 times GDP. Interest alone now costs the government over $1 trillion a year. To fund it, money supply expanded rapidly, creating inflation, asset bubbles, and inequality. Markets reached extreme valuations while wages lagged behind. Stage 2 became obvious. Stage 3 is the quiet exit. China reduced treasury holdings by hundreds of billions. Japan, Saudi Arabia, and European nations are also trimming exposure. Even the Federal Reserve is shrinking its balance sheet. More U.S. debt is now being bought internally with newly created money. That is not a sign of strength, but of stress. The world's largest investors are already repositioning. BlackRock, managing over $10 trillion, has reduced U.S. Treasury exposure while increasing allocations to emerging markets, European infrastructure, Asian real estate, gold, and commodities to limit reliance on the dollar. JP Morgan has adjusted institutional portfolios. Goldman Sachs lowered U.S. equity recommendations. Morgan Stanley raised guidance for international assets. Bridgewater Associates has warned for years about dollar devaluation and positioned its capital accordingly. Just like in Spain, Amsterdam, and London, smart money is moving. Stage 3 is visible. History shows what follows. Reserve currencies do not collapse overnight. They fade, then fall. Trade begins settling in other currencies through bilateral agreements and new payment systems. China and Brazil use yuan. India and Russia trade in rupees. BRICS nations are building infrastructure that bypasses the dollar. The dollar's grip on global commerce is slowly weakening. As dollar demand falls, foreign-held dollars return home, pushing inflation higher. The Federal Reserve then faces a trap: raise rates and make massive debt impossible to service, or print more and destroy purchasing power. Either path drains liquidity. Asset prices fall together. Stocks, bonds, and real estate deflate. Banks, pensions, and insurers come under pressure. And the middle class, holding wealth in dollar assets, absorbs the damage. Many believe America is different. History disagrees. Spain had unmatched armies. The Dutch had advanced finance. Britain ruled global trade. None escaped economic mathematics. Military power cannot stop currency erosion. Technology cannot cancel debt. And exceptionalism is the story empires tell themselves before decline. In history, money printing has never created real wealth. In Zimbabwe, people needed wheelbarrows of cash to buy bread. $1-trillion notes became worthless paper. In Venezuela, inflation crossed unimaginable levels, and professionals were forced into survival jobs. Argentina printed repeatedly, reset currencies, and still faced decades of economic pain despite rich resources. Printing money doesn't produce value. It transfers it from savers to debtors, from workers to asset holders, and from the middle class to financial elites. When confidence finally breaks, the collapse accelerates. Every empire believes it is different. Every reserve currency thinks it is permanent. History proves otherwise. Economic cycles do not care about politics, promises, or narratives. They move like mathematics, steady and unavoidable. Right now, the signals point to stage 3. So what does that mean personally? If most of your wealth sits in dollar-based assets, your risk is real. Diversification is no longer optional. Assets like gold, silver, commodities, and real property cannot be created by central banks. markets. Geographic diversification also matters, spreading capital across stable currencies and jurisdictions. Liquidity gives flexibility during crises, while heavy debt becomes dangerous when rates rise. Reduce leverage, build useful skills, and strengthen relationships. Human capital survives when financial systems fail. Those who understand patterns early don't panic, they prepare. History doesn't repeat perfectly, but it rhymes. And the rhythm right now is unmistakable. The real question is simple. Will you be positioned wisely when the shift happens? Or will you look back, like millions before you, wondering how the warning signs were so obvious and yet ignored? The information is available. The pattern is visible. The data can be checked. What you do with it is your decision. If you agree, disagree, or are still unsure, leave a comment. Share what steps you're taking, what concerns you have, and what questions remain. I read every response. And if this topic matters to you, subscribe, because the next video breaks down 3 sectors that have historically performed best during currency crises. Areas that can protect wealth, and sometimes even create opportunity in turbulent times. These cycles don't ask for belief. They don't wait for approval. They move forward the same way every time, driven by economic reality, not opinion. History shows that survival in major transitions isn't about who has the most money. It's about who has the best information, the clearest understanding, and the discipline to act before the crowd does. Thanks for watching. Stay aware, stay prepared, and remember, opportunity belongs to those who recognize patterns early and move before they become headlines.